Trex Company presents a really fascinating paradox in the market right now. Here we have an industry leader boasting elite profit margins and exceptional returns on equity, yet it recently suffered a pretty brutal 33% decline in its stock price. When a dominant, highly profitable business takes a hit like that, it absolutely demands an in-depth analysis to figure out what the market is missing, or, frankly, what it's accurately fearing.
So, that brings us to the central mystery of our investigation today. Is Trex Company a hidden gem just waiting for this cyclical storm to pass, or is it a housing trap that's going to drag down your portfolio? To find out, we're going to completely tear down their business model, scrutinize their financials, and map out the specific macroeconomic risks they're facing right now.
Okay, let's dive into this. Here is our analytical blueprint for today's explainer. First, gem or housing trap. Then, the business of decking, crunching the numbers, and the cyclical risk. After that, we'll map out the bull, base, and bear scenarios before wrapping up with the final verdict. Section 1. Gem or housing trap. Understanding Trex's current market position is absolutely crucial for long-term investors. We are dealing with a company that's actively transitioning from a pandemic-era hypergrowth story into what might just be a steadier, long-term compounder.
Section 2. The business of decking. Look, before we even glance at a single valuation metric, we have to understand what Trex actually manufactures. Unlike speculative software companies, Trex makes tangible physical goods with highly understandable economics.
The entire core thesis here relies on a massive secular shift away from traditional wood. Let's face it, wood deteriorates, it demands endless staining, and it fuels deforestation. Trex's premium composite decking solves all of this. It's incredibly durable and highly eco-friendly, literally upcycling millions of pounds of plastic and wood scrap while requiring virtually zero upkeep. Homeowners are happily paying a premium just to ditch all that maintenance.
And within that rapidly growing composite space, Trex has built an absolute fortress of a competitive moat. They dominate North America, not necessarily through high switching costs, but through pure brand supremacy and massive distribution scale. Homeowners demand the name they trust, and contractors, well, they stay fiercely loyal because Trex products perform predictably. That means fewer expensive callbacks for warped boards. Add in their massive recycled material supply chain, and smaller rivals simply cannot keep up. Section 3. Crunching the numbers. Okay, so the business model is airtight, but how does that physical product actually translate into hard financial data? It's time to dig into the balance sheet. And this brilliantly illustrates exactly why Trex commands Wall Street's attention, a massive 24.3% operating margin. For a manufacturer of physical building products, that is just exceptional. It proves immense pricing power and really strict operational discipline. By utilizing cheap recycled inputs while charging premium prices, their margins have remained pretty much bulletproof, even through all the recent inflationary spikes.
But you might be wondering, what do they actually do with those elite margins? Well, they generate cash. Specifically, $215.3 million in trailing free cash flow. This really answers the vital "so what" of their profitability. Trex is a cash-generating machine. It allows them to consistently buy back shares and fund their own manufacturing expansions organically. That means they completely avoid taking on toxic debt just to stay afloat during cyclical downturns.
Pulling these numbers into a valuation summary reveals a really fascinating picture. At a current price of roughly $39, the stock is trading modestly below its discounted cash flow intrinsic value of $47. It also boasts a stellar return on equity of over 20%. But here's the catch, that PEG ratio of around 2.2. A PEG above 2 means that, well, even after a 33% price drop, the market is still pricing in a premium for this level of quality. So it's modestly undervalued for sure, but it's not exactly a deep value fire sale. Section 4. The cyclical risk. Now we have to address the elephant in the room. This is the core tension of our in-depth analysis: internal manufacturing excellence colliding head-on with brutal external macroeconomic forces. Now, what's really interesting about this slide is our overall SWOT score for Trex. It comes out to a very solid 7.2 out of 10. That 72% reflects the immense strength of their brand, their margins, and their cash flow. But that 28% gap holding them back from a perfect score, that perfectly encapsulates the moderate but very real cyclical risk this business carries. Make no mistake, they are heavily exposed to the broader economy. Drilling down into those specific external threats really explains that recent 33% stock drop. Trex is incredibly sensitive to housing recessions. When interest rates are high, homeowners can't easily tap into home equity loans, causing them to delay major deck renovations entirely. As a result, revenue growth recently stalled to just 1% year-over-year. Combine that consumer freeze with rising competitive pressure from aggressive rivals like AZEK, and you can clearly see the massive headwinds holding the stock back right now.
Section 5. Bull, Base, and Bear. So we have elite profitability on one side and heavy housing cycle risks on the other. How do we actually model this out for the future?
Comparing these three scenarios side by side gives us a fantastic valuation framework. In our bear scenario, assuming flat growth and prolonged housing weakness, fair value sits somewhere between $30 and $34. Our base scenario, which values the stock between $45 and $47, relies on a return to normalized free cash flow growth of about 7 to 8%. Nothing explosive, just steady normalization. But in a bull scenario, a booming return to the renovation cycle could easily push intrinsic value way up into the $58 to $65 range.
Section 6. The final verdict. Let's move to and see how this builds into our actionable takeaways. We've weighed the undeniable secular shift toward composite decking against those immediate macroeconomic headwinds. Here is where the dust finally settles.
For those of you looking to position yourselves, here is a step-by-step strategy based on intrinsic value. If you're targeting 9% or more in annual returns, patience is absolutely key. The stock becomes an aggressive buy only if cyclical pessimism drives it down below $32. Between $32 and $38, it's a solid buy. Entering the $38 to $48 range, which is exactly where we are today, it is strictly a hold. And if market euphoria somehow pushes it above $55, well, that is your signal to start trimming your position.
To summarize our in-depth analysis today, Trex is absolutely a high-quality company, but it is undeniably a cyclical one. It is trading modestly below its normalized intrinsic value right now, but it doesn't have a massive margin of safety. As it transitions from a hyper-growth pandemic darling into a steady compounder, it's really best viewed as a cautious hold or maybe a gradual accumulation candidate for the highly patient investor.
Ultimately, Trex's short to medium-term fate is completely tethered to the broader economic cycle. So I'm going to leave you with this question for your own portfolio analysis. Where do you think the housing market is headed next? Are we stuck in a prolonged freeze, or is a massive renovation boom waiting just around the corner? Thank you so much for joining me for this explainer, and keep learning.